On December 17, 2025, the U.S. Department of the Treasury releases the Treasury International Capital (TIC) data for October 2025. The press release arrives at 4:25 Washington time as scheduled. No drama, no urgency. Buried in the tables and footnotes lies a stark mechanical fact. China's reported holdings of U.S. Treasury securities stand at $688 cents and $48 billion, down from $700.41 billion in September. This marks the lowest level since November 2008. A descent of more than 47% from the peak of around $1.32 trillion in late 2013. The decline has been methodical, month after month, through 2025, as Beijing trims exposure in a pattern consistent with broader reserve diversification. Total foreign holdings of U.S. Treasuries dipped modestly by $5.8 billion to $924.3 billion in October, from $924.8 trillion in October, from $924.8 trillion in September, reflecting a mix of net sales, valuation adjustments, and flows. The overall figure remains comfortably above $9 trillion for the 8th consecutive month. Benchmark 10-year yields have climbed grudgingly through the year, lingering in the 4.5% range without sharp spikes or disorderly moves. Auctions proceed, bid-to-cover ratios hold in acceptable territory, primary dealers take their allotted share as required, and tail extensions, where winning yields exceed pre-auction expectations, appear occasionally, but never critically. No auction fails. The market digests the supply pressure with an eerie, almost mechanical composure. Market participants register China's reduction with clinical restraint. Aggregates from Bloomberg, CEIC, and IDN Financials trackers show the outflow continuing a trend that accelerated during periods of heightened geopolitical tension and sanctions. Hedging. China's sales pair with documented gold reserve buildup. Official holdings rise steadily through 2025, as reported by the People's Bank of China and tracked by the World Gold Council, serving as a hedge against dollar-centric risks. No sudden dump materializes. The reductions appear graduated, incremental, absorbed without visible fracture. The U.S. Treasury Department's own release underscores the inherent limitations of the TIC framework. Holdings are attributed by the location of the custodian or intermediary, not the beneficial owner. This custodial bias means private portfolio managers acting for foreign clients may route through third-country entities, and official flows can disappear behind veils of aggregation. The press release explicitly cautions, for these reasons it is difficult to draw precise conclusions from TIC data about changes in the foreign holdings of U.S. Treasury securities. Attribution remains imprecise. Conclusions tentative. Initial reactions lean toward downplaying disruption. Japan, the largest reported holder, increases its position to approximately $1.2 trillion in October, up from $1.189 trillion in September. The United Kingdom rises to $877.9 billion from an $864.7 billion. These offsets sustain the narrative of durable foreign demand. Oversight entities, Federal Reserve staff, Treasury analysts, primary dealer desks track the flows as routine data points in ongoing deficit financing continuity. The ecosystem's guardians, seasoned from years of post-pandemic issuance surges and quantitative tightening, view the creditor substitution as noteworthy but not yet alarming. Yet subtle anomalies emerge in the custody breakdowns. The United Kingdom's holdings climb through City of London/Eurodollar conduits, reflecting plumbing that channels flows without revealing ultimate owners. Belgium's position, often linked to Euroclear custodial aggregation, hovers in elevated territory, around $374–470 billion range in recent aggregates. Though exact October figures align with custodial surges, the Cayman Islands registers reported holdings around $418–424 billion stable on the surface, yet flagged in concurrent analysis as potentially masking far larger exposure. A Federal Reserve note from October 2025 dissects the cross-border dimensions of the Treasury basis trade. Hedge funds, predominantly domiciled in the Cayman Islands, exhibit massive Treasury exposure growth. From January 2022 through December 2024, Cayman-based hedge funds absorbed net purchases estimated at $1.2 trillion in notes and bonds, equivalent to 37% of net issuance during that period, rivaling all other foreign private investors combined. adjusting for underreporting and TIC data, estimated at roughly $1.4 trillion by end 2024, potentially elevating adjusted holdings toward $1.8 trillion or more. The jurisdiction emerges as a dominant force when reconciled with Form PF regulatory filings, repo data, and other sources. This rerouting provides the quiet bid. China's sovereign drawdown relocates through opaque plumbing, UK channels, Belgian proxies via Euroclear, Cayman footprints reflecting leveraged arbitrage desks. No surge in broad-based organic private demand replaces the departing official holder. Instead, repo-funded, highly leveraged positions step forward incrementally. The first faint institutional foreboding registers not in headlines but in ledger scrutiny. Repo rate monitors note minor wobbles in short-term funding. Auction desks log incremental tail dynamics without panic. TIC compilers chart jurisdiction spikes dispassionately. The Treasury market endures deficit funding continuity preserved. The myth of unbreakable liquidity depth intact on the surface. Beneath the calm entries, however, a precise pressure test begins. When a major geopolitical counterparty methodically reduces holdings pairing sales with gold accumulation and sanctions avoidance logic, the core premises of foreign demand durability, unleveraged absorption capacity, and custodial transparency encounter quiet, unrelenting scrutiny. The system absorbs. Yet the composition shifts from entrenched sovereign balance sheets to more transient, policy-contingent, repo-dependent alignments. The screens continue scrolling, no alarms sound. But the data points accumulate, each one a small, cold indication that the theater's depth may be more contested than it appears. The absorption narrative persists in initial commentary from Bloomberg aggregates and IDN financial summaries. No disorderly yield spike materializes. 10-year notes trade within the established 4.5% corridor through late 2025, with auction clearances remaining functional despite occasional modest tails. Primary dealers fulfill their obligations. The bid-to-cover ratios, while not exuberant, avoid distress levels. Oversight desks note the continuity. Deficit funding rolls forward without interruption. The liquidity myth reinforced by the absence of visible fracture. Deeper scrutiny, however, shifts to the jurisdictional reallocations that quietly offset the sovereign exit. The United Kingdom's reported increase, approximately $13.2 billion month-over-month, aligns with patterns long associated with City of London Eurodollar plumbing. These conduits aggregate positions from multiple beneficial owners, channeling inflows through UK-based intermediaries that obscure ultimate nationality. Belgium's custodial footprint, frequently linked to Euroclear's centralized settlement and custody services in Brussels, registers in elevated ranges. Historical aggregates place it around $470 billion territory in recent periods, with surges reflecting proxy aggregation rather than pure Belgian official demand. These jurisdictions do not announce motive. The data simply record the relocation. The custodial veil is not new. TIC documentation is long cautioned. The positions reflect the location of the securities safekeeping or intermediary, not the economic owner. Private portfolio managers for foreign clients routinely route through third-country entities. Official reserve managers may employ similar techniques for operational or risk management reasons. The October release reiterates the limitation explicitly. Precise inferences about country-level changes remain elusive due to these attribution biases. Foreign countries may also maintain dollar assets outside TIC capture entirely. Into this opacity steps the leverage dimension. The Federal Reserve's October 15, 2025 Fed's note, the cross-border trail of the Treasury basis trade, dissects the discrepancy between reported TIC positions and regulatory filings. Cayman Islands domiciled hedge funds, the primary vehicles for basis trade activity, exhibit massive Treasury exposure growth. From January 2022 through December 2024, these entities absorbed net purchases estimated at $1.225 trillion in notes and bonds, equivalent to over $5 trillion in notes and bonds, equivalent to roughly 37% of net U.S. Treasury issuance over that span, rivaling or exceeding all other foreign private investors combined. Yet, TIC reports Cayman holdings at far lower levels, around $434 billion in recent months, creating an estimated undercount of approximately $1.4 trillion by end 2024 when reconciled against Form PF data. Hedge fund regulatory filings. repo market volumes, and financial accounts of the United States. Adjusted estimates place Cayman exposure toward $1.85 trillion or higher, positioning it as potentially the dominant foreign holder when accounting for the basis trades cash futures arbitrage mechanics. Funds purchase cash treasuries, finance via repo, and hedge duration risk with short futures positions, capturing the basis spread in a highly leveraged structure. This rerouting is mechanical, not conspiratorial. China's gradual sales tide to reserve diversification, gold accumulation, ongoing PBOC increases through 2025, and sanctions hedging logic find a bid not in broad organic private demand but in arbitrage desks exploiting persistent basis opportunities. The UK and Belgium surges likely incorporate elements of this plumbing. Eurodollar channels and Euroclear aggregation facilitate the flow of leveraged positions without direct attribution. No sudden private sector enthusiasm replaces the sovereign drawdown. Instead, repo-dependent, policy-contingent capital steps forward. Early strains register subtly. Repo rate observers monitor for deviations in soft or general collateral financing costs. Minor wobbles appear but no sustained elevation. Auction monitors log incremental tail extensions as supply pressure meets a more price-sensitive bid. TIC compilers document jurisdiction spikes without causal narrative. The system continues to clear auctions, fund deficits, maintain composure. But the composition shift deepens. Sovereign balance sheets, durable, countercyclical, geopolitically anchored seed ground, to transient alignments, hedge fund vehicles sensitive to funding conditions, basis spreads, regulatory constraints, and margin calls. The custodial rerouting sustains absorption in the near term. Opacity masks the substitution's fragility. When repo markets remain stable and basis spreads remunerative, the bid endures. Should conditions tighten higher funding costs, volatility spikes, or regulatory pressure, the leverage layer could prove less reliable than the departing official creditor. The screens scroll onward, no fracture yet, but the ledger entries now carry a quiet weight. Creditor loyalty erodes not through dramatic exit but through incremental rerouting, where durable demand gives way to arbitrage opportunism and repo-funded depth. The pressure test intensifies, measured and unrelenting. The Federal Reserve's October 15, 2025 analysis on the Treasury basis trade lays bare the scale. Cayman Islands dominated hedge funds absorbed an estimated $1.225 trillion in net purchases of notes and bonds from January 2022 through December 2024, roughly 37% of net issuance during that period, matching or exceeding all other foreign private investors combined. This activity exploits the persistent cash futures basis. Funds buy Treasury securities outright, finance them via repo markets, and simultaneously short equivalent Treasury futures to lock in the spread. The structure is inherently leveraged, often 50-100 times, to generate returns on the narrow basis. TIC reporting captures only a fraction of this exposure. Reported Cayman holdings hover around $424 billion in October, yet foreign PF regulatory filings and financial accounts reconciliation suggest an undercount of approximately $1.4 trillion by end 2024, potentially elevating adjusted exposure toward $1.8 trillion. This makes the Cayman Islands, when properly adjusted, the dominant foreign holder, dwarfing China's reported position and even surpassing Japan and the United Kingdom on the unadjusted major holders table. The UK and Belgium custodial surges complement this picture. The United Kingdom's October holdings rise to $877.9 billion, channeling flows through City of London Eurodollar conduits that aggregate positions without clear beneficial owner attribution. Belgium's elevated levels, often linked to Euroclear's centralized custody in Brussels, serve as a similar proxy, facilitating the routing of leveraged trades. These jurisdictions do not represent pure sovereign or private demand. They function as plumbing, obscuring the ultimate holders while sustaining the bid for U.S. issuance. Auction dynamics register the shift's subtle pressure. Bid-to-cover ratios remain acceptable, but show incremental softness in late 2025 reopenings. Tails, where the auction high yield exceeds pre-auction when issued levels, appear more frequently, signaling that the bid is becoming more price-sensitive. Primary dealers absorb higher allotments on weaker days, distributing supply into secondary markets without immediate disorder. Yields climb grudgingly within the 4.5% range. but the absence of outright failures masks the underlying mutation. From countercyclical sovereign balance sheets to pro-cyclical, funding-dependent arbitrage desks, repo plumbing emerges as the critical vulnerability. The basis trade's viability depends on stable, low-cost repo financing. Secured overnight financing rate, SOFR wobbles, appear in late 2025 minor elevations and occasional quarter-end spikes reflecting thinner liquidity cushions amid ongoing quantitative tightening and elevated Treasury issuance. While no acute stress materializes, repo rate observers note deviations. SOF occasionally drifts above policy levels, signaling cash scarcity in secured markets. The standing repo facility sees limited usage, yet the potential for tighter funding conditions looms. Volatility rises. Margin calls could force rapid unwinds of leverage positions. The structural cracks widen. The leveraged layer is transient by nature, sensitive to basis spread compression, regulatory changes, counterparty risk, or sudden shifts in funding costs. Unlike official reserves held for decades and adjusted gradually, these positions can reverse abruptly under stress. A tightening of repo markets could trigger margin spirals, forcing hedge funds to sell treasuries en masse to meet calls, amplifying yield volatility and undermining the absorption capacity that appears so calm on the surface. Compilers continue charting jurisdiction spikes dispassionately. Fed researchers flag the undercount without ascribing imminent crisis. Auction monitors log tail extensions as data points. The ecosystem's guardians register the foreboding. The market withstands China's methodical exit. Yet stability now rests on alignments that are both opaque and fragile. Sovereign creditor loyalty erodes. In its place rises a framework of arbitrage, opportunism, and repo dependency. The screens scroll relentlessly. No fracture has occurred, but the descent is measurable, from superficial poise through custodial substitution to the recognition of leveraged brittleness. The pressure test now probes not just demand durability, but the resilience of funding conditions themselves. The system endures ununisly. Total foreign holdings stabilize around $9.243 trillion in October, with aggregates from Bloomberg, CEIC, and IDN Financials trackers showing resilience above $9 trillion across recent months. Japan maintains its lead at roughly $1.2 trillion. The United Kingdom at approximately $878 billion. Belgium in elevated custodial territory reflecting Euroclear aggregation. The Cayman Islands reported position hovers near $424 billion. Yet the Federal Reserve's October 2025 analysis underscores the persistent undercount. Adjusted estimates place exposure toward 1.85 trillion, cementing the jurisdiction as the effective largest foreign holder when reconciling TIC with foreign PF filings and repo volumes. The leveraged framework entrenches itself. Basis trade desks, predominantly Cayman domiciled hedge funds, continue absorbing net issuance through cash futures arbitrage, purchasing treasuries, financing via repo, hedging with short futures to capture the spread. From January 2022 through December 2024, these entities net purchased an estimated $1.225 trillion in notes and bonds, equivalent to 37% of net issuance in that window. The structure remains viable so long as repo conditions stay accommodative. SOFR anchored near policy levels with only minor quarter-end wobbles, no sustained stress in secured financing. Standing repo facility utilization contained. Auction clearances persist without failure. Bid-to-cover ratios hold functional, though tails register occasionally as the bid grows more price-sensitive. Yields on 10-year notes linger in the established 4.5% corridor into late 2025 and early 2026, grudging rather than disorderly climbs. Primary dealers distribute supply as mandated. Deficit funding continuity is upheld. No broad organic private surge replaces the departing sovereign. The offset arrives through proxy plumbing. UK City Eurodollar channels, Belgium Euroclear veils, and repo-dependent arbitrage, yet equilibrium holds uneasily. The creditor composition has mutated irreversibly from entrenched, geopolitically anchored sovereign surpluses to transient, leverage contingent positions sensitive to funding costs, basis compression, margin dynamics, and regulatory shifts. Repo plumbing remains the latent fault line. A tightening, whether from volatility spikes, higher collateral demands, or policy contingencies, could precipitate rapid unwinds, margin spirals, and amplified yield swings. The system has withstood China's accelerated drawdown through 2025 without fracture, but stability now hinges on fickle alignments rather than durable official demand. Institutional foreboding lingers in the monitoring ribs. Repo rate watchers track for deviations. Auction desks log tail extensions. TIC compilers note jurisdictional distortions without resolution. Fed researchers reiterate the custodial and attribution biases that obscure precise ownership. The pressure test continues incrementally, no dramatic rupture, only the measured erosion of premises about Treasury liquidity depth and foreign demand durability. In multipolarity, dollar creditor resilience is being tested, not yet broken. Dominance endures not through unchallenged strength alone, but through substitutions and alignments that render exit tolerable momentarily at the expense of concealed brittleness. Subscribe for ongoing dissections as this unfolding dynamic evolves.